All right, welcome. Today, we're jumping into a question pretty much everyone with a savings account asks themselves at some point. Okay, what do I actually do with my money? We are going to break down how you build an investment portfolio, from the Nobel Prize winning theory that started it all to the real world strategies that pros use to navigate the markets today. And yeah, for most of us, this is the big question, right? It feels like this incredible high wire act. You want your money to grow, of course, but that fear of a market crash or just picking the one stock that tanks, it can be absolutely paralyzing. So, how do the pros do it? How do they build portfolios that are actually designed to weather the storm? Let's dive in. So here's our game plan. We're going to start with the fundamental problem every investor faces. Then we'll get into the theory that totally changed the game. From there, we'll unpack the huge debate between active and passive investing, take a little tour of the different playbooks fund managers use, and wrap up with how your own values can shape your investment strategy. You see, the real challenge in investing isn't just about trying to find the next Amazon. The number one risk you face is that the one stock you pick just doesn't do what you expect it to, or even worse, it goes down. A lot. Holding just one stock is basically an all or nothing bet. So, how do you deal with that risk? Well, the answer really came back in 1952 from an academic named Harry Markowitz. And his work kicked off this revolutionary way of thinking about building a portfolio. It's called Modern Portfolio Theory, or just MPT for short. Now, the key idea here is that MPT isn't about getting rid of risk altogether. That's impossible. It's about managing it through something called diversification. The whole concept is that the risk of a whole bunch of stocks combined is actually less than the risk of any single one of them. It's basically the math that proves the old saying, don't put all your eggs in one basket. MPT actually breaks risk down into two types. Over on the left, you've got systematic risk. Think of this as market risk, stuff like recessions or interest rate hikes, things that hit everybody. You just can't diversify that away. But on the right, you have unsystematic risk. Now this is company specific, a bad product launch, a factory fire, a huge scandal. This is the kind of risk that MPT is specifically designed to get rid of. And this right here, this is where you see the magic of diversification in action. Just look at that top graph. See how as you add more stocks to your portfolio, that total risk just plummets? The big takeaway is that with just 15 to 20 carefully chosen stocks, you can pretty much eliminate almost all of that dangerous company-specific risk. What's left over is just the baseline risk of being in the market at all. Okay, now shift your eyes to the bottom graph. Once you've diversified away all that company-specific risk, MPT gives us this really powerful idea called the efficient frontier. Just think of it as the ultimate sweet spot for investing. It's a curve that shows you the absolute highest return you can possibly get for any level of risk you're willing to take on. So the goal of a really smart investor isn't just to diversify, it's to build a portfolio that lands right on that line. That's how you know you're getting paid for the risk you're taking. So MPT gave us this incredible framework for managing risk, but it left a huge question unanswered. Can you actually do better than average? Can you beat the market by just picking the right stocks? And that's where the next big, and believe me, very controversial idea comes into play, the efficient market hypothesis, or EMH. So the core idea of EMH is that it's basically impossible to consistently beat the market because all the information out there is already reflected in a stock's price. The semi-strong form is the one that gets talked about the most. It says that by the time you read about a company's amazing quarterly earnings, it's too late. The stock price has already moved. That means that trying to find some hidden gem through analysis is probably a waste of time. And this whole debate, are markets efficient or not, it leads you directly to the single biggest fork in the road for every single investor. Are you going to be an active investor or a passive one? This is the question that really launched the entire passive investing movement. I mean, think about it. If you believe that all the information is already baked into the price and that you can't consistently find undervalued stocks, then why on earth would you pay a manager a ton of money in fees to try? These two approaches are total opposites. Active managers, well, they believe they can outsmart the market. They're betting that markets are not perfectly efficient and they can find those hidden bargains. Passive managers, on the other hand, basically say, you can't beat them, so join them. Their goal is just to match the market's performance, usually by tracking an index like the S&P 500, and they do it for way, way lower fees. And you know, the case for passive investing is pretty strong. A huge advantage is that when you look at the data, very, very few active managers actually manage to beat the market year after year, especially after you factor in their higher fees. But look, it's not perfect. An index fund isn't customized for you, and it has zero defense in a downturn. If the market tanks 20%, guess what? Your index fund is going right down with it. Okay, so let's say you do want to try and beat the market. How do you actually do it? Well, active managers aren't just throwing darts at a board. They follow specific playbooks or styles. So let's take a quick tour of some of the most popular ones. First up, you've got the classic value investing. This is the style perfected by legends like Benjamin Graham and, of course, Warren Buffett. Value investors are basically bargain hunters. They're digging through financial statements, looking for really solid companies that the market has sort of unfairly beaten up for some reason. The whole bet is that the market overreacts to bad news, which creates these awesome opportunities to buy great businesses on sale. The catch? You have to be incredibly patient, because it can take years for the market to catch on. Now, on the complete other end of the spectrum, you have growth investing. These folks are not looking for bargains. They are looking for rockets. They're trying to find those innovative companies in fast-growing industries that have the potential for absolutely explosive growth. They're totally willing to pay a high price today because they believe it's going to be a much, much bigger company tomorrow. This style can give you those massive returns, like we thought with tech stocks, but it's also a lot riskier if that explosive growth never actually shows up. Then there's momentum investing, which is a whole different beast. A momentum investor doesn't really care about a company's financial health or its future potential. They care about one thing: price trends. It's all based on this idea that winners keep winning and losers keep losing, mostly because of investor herd mentality. So they buy stocks that are already soaring and they sell stocks that are falling. It's all about riding that wave of market sentiment, but you have to be really quick to jump off before that wave crashes. And finally, we have contrarian investing. This is the philosophy of being brave when everyone else is freaking out. Contrarians actively bet against whatever the popular opinion is. When a stock or a whole industry is just hated and everyone is selling like crazy, that's when they start buying. Now, this isn't just about being stubborn. It takes a ton of research to prove that the crowd is genuinely wrong. It is incredibly risky, but if you get it right, like buying bank stocks in the middle of 2009, the returns can be absolutely legendary. Now, beyond all these traditional styles, there's a really powerful new force that's shaping how people build their portfolios today, and that's an investor's own personal values. This whole movement is often summed up by the letters ESG. It's really just a way of looking beyond the raw numbers. So E is for environmental. What's the company's impact on the planet? S is for social. How does it treat people, its employees, its customers, the whole community? And G is for governance. How is the company actually run? Is its board independent? Is executive pay fair? That kind of thing. And investors put these values into practice in a couple of mean ways. The first is called negative screening. It's pretty simple. You just make a list of industries you don't want to support, like tobacco or weapons, and you just exclude them. Positive screening is the flip side. It's more proactive. It means you're actively looking for companies that are leaders in ESG or companies that are actually providing solutions to big challenges like developing renewable energy. So we've gone on quite a journey, from the pure math of modern portfolio theory to the practical playbooks of value and growth, and all the way to the very personal choice of what values you want your money to stand for. Building a portfolio isn't just a financial calculation anymore. It's also a statement about what kind of future you want to invest in. So the real question is, what does yours say?